Good evening, Mr. Knight, Mr. Kumalo, Triumph, Zelda. Good evening to you all. Good evening, B, Graham G. How's it? Good evening, GK. Good evening, Ati Hartnik. Zelda, hello Zelda. How's it going? Jake Scott, good evening, Nakutla. Good evening, folks. Jacqueline joined. How's it? Good evening to you, brother. Good evening, Mr. Knight. Welcome back. I'm sure you've been here from before. Thursday night Q&A time. You ask questions, I try and answer it. Basically how it goes, eh? And while we wait for some people to come in, I get to look at all the different names of people. Always so interesting to see what people call themselves on social media. Adolf van der Merwe, goeienaand aan jou meneer van der Merwe. LPGP, very interesting. Estelle Crowley, Hannes Paulus, GK was on, GK was off, GK is back. Goeienaand Adolf, hello. Monique, good evening, goeienaand. Mr. Knight, same names are just out of, some names, yes, some names are all out of order. We won't mention them all. Adolf van der Merwe, die 4 keer sal weer wapper. Okay, Adolf, I'll say, stoere boer daar ondersteuner. Where can I invest 10,000? Ayana says, where can I invest 10k per month and take it after 5 years? Ayana, you can basically invest 10k per month just about anywhere. And when I say you can invest it just about anywhere, I mean you can go and put it into unit trust, endowments, preferably, and after 5 years you can withdraw the money. The only thing is that if you put it into unit trust, so let's assume it's 120,000 rand per year, it's 600,000 rand over the period. Let's say it's worth 900,000 rand at the end of 5 years, you will have to pay capital gains tax on that 300,000 rand growth. If you do the same investment but you make use of an endowment, then there will be no capital gains tax as everything is taken care of within the investment. I would not necessarily advise you to or recommend that one goes into a tax-free investment if you want to take it after 5 years, because it's preferable to leave tax-free investments for a long period of time. I would say that tax-free investments only start really giving you that extra benefit of being a tax-free investment and the growth in it after 10 years or longer. So Ayanda, that would be my recommendation, unless of course if you want to invest 10k for 5 years and you don't have an emergency fund, it might also be good to channel some of those funds into a normal bank savings account, money market account or something like that, just so that you have that emergency fund ready. Okay, and then Ayanda, I hope that one answers it for you. Graham G says, here we go, that RA below 360k accessible 100%, could one plan this over multiple policies? Yes, Graham G, you can. I wouldn't do that. I think it would be absolutely ridiculous to do that, but yes, you can. So basically what you can do is you can choose to have, let's say, 4 different retirement annuities with 4 different companies. One with an Old Mutual, one with an Allan Gray, one with Sanlam, one with Liberty for argument's sake, and ensure that you contribute little enough with little enough growth, so that when you get to retirement, all 4 of your retirement annuities are less than 360,000 each, because then every company would allow you to withdraw that 360,000 rand. It wouldn't make sense to me, because first of all, if you do that, you limit yourself in terms to the tax rebates you can get on your contributions. That's the first thing. That's what retirement annuity is all about. Secondly, you get to retirement and now you've saved or invested in your retirement annuities all these years in order to get the rebates on the premiums. And over and above that, you've done it so that in retirement you can get 550,000 tax free on your 1/3, and then plan your income so that you pay a lower tax rate. Now you go and you withdraw 360,000, you start paying withdrawal tax. So to a certain extent, you have just cancelled out all the benefits that you've had over the years, and what the retirement annuity was intended for. So yes, Graham, I think you can plan it like that, but I don't think it makes any sense to me. And like you just said, now avoid the 1/3 capping. Personally, I think that is the ideal thing, is the 1/3 capping. I had a gentleman that asked me today and was very disappointed because he can't withdraw his entire pension fund money, and why he can only withdraw 1/3 of his pension fund and the other 2/3 have to go into an income. Very upset that the system is so unfair, because he can take all his pension fund money now and he can go and buy a house and rent it out, or he can go and buy a business. And I said to him, sir, with all due respect, you've worked for a company all these years. You've earned a salary over all these years. Now you go into retirement. What makes you think that you can actually run a company? What makes you think that you can build a successful company? What makes you think that you can manage a property? Because managing a property is like running a company. And he was very adamant, no, I'll make a success of it. And I gave him the stats. I told him that basically 2 out of every 10 companies started survives, and only 1 out of every 10 companies really become successful. So you want to take money that you have invested for many years, that you've diversified over a risk spectrum so that you don't lose anything, and then you want to take the chance of withdrawing everything and utilizing it for one big risk that you want to put your money on. Because if you want to avoid the capping of the 1/3, that's exactly what you want to do. So Graham, I hear what you're saying, but my honest opinion is that would be one of the worst planning exercises anybody can do. So I hope you don't do it, Graham. I hope you don't do it. How's it, Ants Man? Nice to see you back on the call again tonight. Don't ask stupid questions again, eh? I love Ants Man. GK, hi Corneille. If you retire and you have a living annuity, you decide to work again, is it possible? Absolutely, GK. As a matter of fact, many people work for a company that they have a pension or provident fund with the company, and their retirement age at the company is 63 or 65. But over the years, they've also taken a retirement annuity in order to supplement their pension in retirement. Then they get to the age of 55 and they think, okay, it's going to be a good idea to take the 1/3, pay off my debt, and take no income from the 2/3. Now you can't do that, so they have to take a very small income of 2.35% from that income. But then they withdraw the 1/3, they go and do what needs to be done. The 2/3 they put into a living annuity, they draw 2.5% income from it, and then they reinvest that 2.5% plus. They then start reinvesting all the money that usually went to the bond or the car, whatever the case might be, and in that way they start investing for later on. But they still keep on working, so they're still contributing towards their pension fund, their provident fund, but now they start getting an income from a living annuity on their retirement annuity. All part of the big scheme, the bigger scheme of things for people when it comes to the planning process and the advice giving process. So I've now elaborated a bit on this and what you can do, but yes, the short and sweet answer is you can retire out of certain funds while you are still working and contributing. I mean, I've had clients that actually retired from their retirement annuities and then started new retirement annuities based on the planning once again, because they're getting enough of an income and now they can contribute to a retirement annuity again to get the tax rebate and therefore get their taxes lower. So yes, can be done. Ayanda, pleasure, Ayanda, anytime. Zelda, Ek het 'n small investment bank at 7.2% interest per annum, seeking the best place to invest with low risk. So Zelda, if you're getting 7.2%, I think the first thing that one has to check is what the value is of that investment. Okay. If that investment is 300,000 Rand or less, then it's very possible that the interest that you're getting is under the interest rebates. I think it's increased now, but it was 23,800 Rand. And if that's the case, then you're actually on a good investment. You're in a good place in terms of your investment. If your investment money is more than 300,000 Rand and now the interest that you're going to earn is more than 23,800, then there is obviously a tax implication. Now the question is, how big is that tax implication going to be? Is it worthwhile me moving into a different investment not to be taxed on that interest? So if you're going to do that, then there's a couple of other questions that comes up. What is your personal income tax, personal income and therefore income tax, your overall assets, how much you've got. So there's a number of questions that needs to be asked. And then you can go and invest in things like a money market account through an investment company where it's taxed within the fund and not in your hands anymore. Or you can make use of bonds, bond funds, or you can make use of stable funds, or you can make use of smooth funds. And all of them are pretty conservative investments. So there's a number of investments that you can do outside of the bank that is low risk. But then again, when it comes to low risk, I would also want to have that conversation with you about why low risk. So often people shoot themselves in the foot because they just want to go low risk when they've got 20, 30 years left to live, or even longer. And that's a very, very long time in investment talk. If you've got such long periods of time left to live, you must take some risk. You must be invested in some form of equity. So it might not be to your best interest to move it out of a bank account into a low risk portfolio. But Zelda, having said all of that, only way we can really give you advice on something like this and give you spot on advice is if we consult with you. So you're welcome to contact us and then we can set up an appointment, okay? Mr. Knight, does the Rockefeller waterfall method work in South Africa with our law and legislation? Mr. Knight, yes it can. It can indeed. How good it will work, I don't know. I think one of the biggest problems that I've got with something like the Rockefeller waterfall method, okay, is that people must understand that you must really earn substantial amounts of income. You must really have substantial amounts of asset to make it worth your while. Remember that if your assets, okay, is not more than 3.5 million, there's no estate duty payable. And if there's no estate duty payable, then there's no reason to really have a trust, which the Rockefeller waterfall method talks about, to put it in. And if your estate is not going to be 3.5 million, chances are very good that you can't afford the life cover that goes hand in hand with that in any case. So I think with regards to that, it really depends on the individual. If your situation warrants something like that, if it's going to be financially worth it for you to go that route. It's always wonderful to listen and to hear all these fantastic and brilliant investment portfolios and ways to do it and whatever. But if it's not viable or feasible for you as an individual, then I cannot really see any reason to do it. Okay. Graham G says, meaning on retirement. Yes, Graham, I think that's exactly what I meant with regards to the 360,000 Rand is at retirement, and I cannot see any reason why the idea that you have is a good idea. So I stand by what I said earlier. Zelda says, I don't need to draw monthly from my investment. I understand that, Zelda, and irrespective whether you actually want to draw from your investment or not, the conversation needs to be had about why you want to be invested so conservatively, what is your assets, what's your income, all those kind of things, in order to determine whether it's worth your while to invest in a conservative investment outside of a bank. I mean, if you're going to earn 7.2% in the bank and not pay any interest, I cannot see any reason to move your funds into an endowment and still get 7.2% without paying tax. It just doesn't make sense to make that move. That's why I say the conversation needs to be had to understand your circumstances before proper advice can be given. Agnes says, hi, are you familiar with the issue of buying pensionable years, especially in GPF? Yes, Agnes, I am indeed familiar with that. GPF works on a formula. So basically what happens is the way your pension that you will receive one day and the 1/3 you will be receiving one day is determined, is they take the years of service that you have and they take the average of your last 2 years of income, and they take your status or your position that you had, and this all is worked into a formula, and that determines how much your 1/3 is going to be and how much your monthly income is going to be. So if somebody works in the GPF or is part of GPF for 40 plus years, that's about the longest period you can get, and you're going to get very close to 90% of your final income as a retirement income if it's added onto the 1/3. The person that's working there for 20 or 30 years obviously is going to get a lot less because they have so many less years, so the formula will give them substantially less. So what happens now is that very often people that joins the GPF later in life, they know that they're only going to have 20 or 25 years or even less at retirement, and they know it's going to impact their formula. And then what they do is they can go to the GPF and they can say, okay, what do I do to buy back years? So then the GPF will say to them, okay, how many years do you want to buy back? 1, 2, 3, 4, 5, whatever the case might be. And then they will tell them, okay, if you want to buy back 1 year, you're going to have to contribute an extra 100 Rand a month to your own pension fund. If you want to buy back 2 years, it's going to be 200 Rand. If you want to buy back 5 years, it's 500 Rand. Now I'm just talking about fictitious figures here. But literally, they will work out for you what you have to contribute extra out of your own pocket towards the GPF in order for you to not retire with 20 or 25 years service anymore, but now to retire with 30 or 35 and therefore have a bigger retirement income at retirement and therefore have a better pension. So that's what it's all about, Agnes. I hope that answers it for you. Ayanda, endorsement may, thank you very much. Yes. More than 300k, less than a million. Zelda, more than 300k, less than a million. That doesn't tell me very much. It tells me that the savings amount that you have in the bank is more than 300,000 but less than a million. It still doesn't tell me what your personal circumstances are in terms of income, other assets, income tax, etc. Only once we know what your circumstances are can we know. But once again, I would leave a portion in the bank as an emergency fund so that I can get access to it very quickly, and the rest I will take towards an endowment. Might even make use of a unit trust depending on what your tax rate is. Jeannie says 53, so lower risk is a must, I think. Jeannie, no, I actually think that lower risk is not a must. I think that lots of people, when they get to the age of 50 and older, they immediately want to go to lower risk because we think, okay, I have to protect what I've built up over the years. And I am of the exact opposite opinion. I think that we should take more risk, pursue more growth, take into consideration that we've got a long time to live, and the only time that people really have to be conservative with their investment is if they are super conservative people or they do not have enough for retirement, but then you have to buy into guarantees. But overall, I would say majority of people I speak to, I prefer for them to take some risk or more risk rather than less. That's my personal opinion. Nicholas Wicken says, opinion on wrap funds. Well, Nicholas, are you talking about life wrapped investment and list wrapped investments? Because that's basically just the terminology to distinguish between a unit trust and endowment, okay? I'm not sure if that's what you're referring to. So I hope I've answered it, Nicholas, but if I misunderstood the question, please just give me a bit more, what do we call it? Detail. Can't think of the word now. Good evening, Tic Tac Toe. Nice to have you back here. Mr. Knight says, that's the best information we can have this far. Oh, thank you, Mr. Knight. I'm very happy if you think so. It's always a bit of a good thing to hear that people are satisfied with what they hear and that it makes sense. Thank you. Tic Tac Toe says, good night, my pension is down by 240k and private investments by 250k. This bloody war. Don't worry, Tic Tac Toe. Don't worry about it whatsoever, okay? If you have to retire in the next month or two, it's a problem, okay? Let's not even make any qualms about it. Might even be if you want to retire next 2 to 4 months, it might be a bit of a problem. But the fact of the matter is, whatever goes down always comes up again. Our stock exchange, Dow Jones Stock Exchange, just about every stock exchange that the portfolio managers invest in, all keeps on going up over time. Okay, there is plenty of times that I can tell you about that stock markets has gone down 10, 20, 30, 40%, but they've always recovered. Sometimes it takes 2 months, sometimes it takes 6 months, other times it takes 18 months, but they always recover. And we're in a similar situation. I like to use the COVID example always because in 2020, when we went to COVID, our markets dropped by 35 to 40% in literally a week or two. And then everybody went into panic stations and advised everybody just to stay calm, not to move their funds, not to withdraw anything, not to get panicky. And literally within 6 months, the people had recovered all their money and seen 10% increase in their investments. So you were down in March by 30-40%, and you were up in August 10% over what you had before the crash started. So don't worry about it. Whatever happens on the short term on investments is not important. What's important is if anybody is in a situation that they can ride it out. You have to worry about markets dropping and collapsing and losing money or whatever when you are a year to 3 years from retirement or a year to 3 years from withdrawing funds. That's when you have to worry about your money. Because remember what I said earlier about being invested in low risk funds? What you want to do is, if you get closer to retirement, you want to ensure that your capital and the growth that you've got has been protected or is protected. So that if you have to retire in say 6 months from now, and you can see that your investment has grown, you've had wonderful growth, whatever, now you want to lock in that growth so that 6 months from now, you can take that growth and you can go and buy yourself new investments, because that's what you literally do. You buy yourself a new income plan if you buy a living annuity or a capital growth plan. Now you want to go and buy new income plans with that money that's been protected. But now, because you're in retirement and you don't have to worry about a maturity date in the future, because now you're going to be in retirement for 20, 25, 30, 40 years. Now you can start taking that money which you protected 6 months before retirement in something that's conservative, and you can go and be more aggressive with it again. Okay. So that's the only time that people really, really, really have to be conservative with their investments. So the people that knew that they're going to go into retirement, let's say from January until June, August this year, those are the people that should have started from December last year to January last year, from December 2025 to January 2025, those are the people that then should have looked at the investment and made a decision. Hey, the markets are running. Am I going to keep on running and hope for the best? Or am I going to lock it in because I've got enough, and at retirement I will then reevaluate the situation? If they haven't done it and you now go into retirement and you take a bit of a knock, well, you just have to make peace with it. But you can also go through this situation now and just say, well, I'm going to hang on for a month or two until it recovers. So tic-tac-toe, sorry, I've now gone into a bit of a long explanation on this stuff, but what I'm trying to say is, unless you need money right now or in the next month or two, don't panic about it. The market will recover, your money will recover, your growth will come back. Let's see who's next. I said answer, thanks. Junior says thanks, great. Zolelo says, hi sir, can you please explain between tax-free savings account and tax-free savings investment? Oh, I get this so often. Zolelo, yes. Okay, so basically tax-free is tax-free, okay? And the way I distinguish between it is, you can open a tax-free savings account at the bank. So you can go to the bank, you can open a tax-free savings account, they will give you a tax-free savings account, and they will tell you, on this tax-free savings account, we're going to give you 4% or 5% or 6% or 7% interest, and that's what you get. Over and done with. A tax-free investment is when you go to an insurance house, an investment house, and you say to them, I want a tax-free investment, and they say, great. What type of portfolio do you want to be invested in? If you want to be invested in a money market account, we're going to give you 6 or 7% growth. If you want to be invested in a medium risk fund, we should be able to give you about 8 to 9.5% growth. If you want to be invested in an equity fund, which is more aggressive and therefore a bit more high risk, the return on investment can be as much as 10 to 14%. And you then decide, based on how much risk you're willing to take, in which of those portfolios you invest. So if you're going to invest for a long time, 20 years, 30 years, 40 years in your tax-free investment, even as little as 10 years, you can actually invest in a very aggressive fund. So you can invest in an equity fund or a global equity fund. So you can go and choose a fund where you hope to get 10, 11, 12, 13% instead of just getting the bank savings account where you get 5 or 6% growth. And that's the difference. The one gives you a fixed growth rate, the other one gives you a potential growth rate. Yes, it can go through ups and downs, you can have dips, but if you wait it out, once again, as per the previous explanation, the tax-free investment should always give you a substantially better return than a tax-free savings account at the bank. Okay, I hope that's clear. Oh, tic-tac-toe. I don't know when last I saw bells. I'll give that man a bells. Triple N says, good day. Where can one put an emergency fund and let it grow steadily but accessible when needed? Well, I would say the only place that, the most preferable place is a bank savings account. Funny enough. And why a bank savings account? Because you've got very quick access to those funds. Be that a normal savings account, be it a money market account, whatever. That's a preferable emergency fund. Yes, I suppose you can make use of a unit trust, and you can go and choose a pretty conservative unit trust, a pretty safe unit trust. But the money is not as easily accessible as a bank account. At the bank account, you can walk into the bank, you can draw the money, ATM, you can draw the money, whatever the case might be. On a unit trust, it takes a few days. So you have to submit this investment request, and then it takes a few days, and the system's not working or something goes pear-shaped, it can take 2 weeks. And depending on your emergency, sometimes I suppose you just don't have 2 weeks. So I would still maintain that, as much as I do not think that banks have good savings or investment accounts for people that are serious about wealth building, having a bank savings account to keep your emergency funds is still one of the best, if not the best, place to keep it. Ranesh Aikone, please can you expand on what a gratuity is when you retire or take early retirement? On what a gratuity is when you retire or take early retirement? Ranesh, I'm not 100% sure. All I can think of, the only gratuity that I can think of is your 1/3 that you get at retirement from your pension fund, provident fund, or retirement annuity. The 1/3 capital that you can withdraw if you wish to withdraw it. That's the only gratuity that I can think of. I hope my brain is not mush tonight, that I'm just missing something here. But yeah, I think that's all. Unless, look, you can get other gratuities. The company that lets you go can give you a gift and say, listen here, thank you for all the years that you spent here. Here's a gift or something like that. But I think from the point you're talking about, we are referring to the 1/3 that you can take in cash, and that 1/3 which is then tax-free to a certain extent, first 550,000 Rand tax-free, and the rest taxable on a sliding scale. And of course you can choose with regards to gratuity whether you want to take the full 1/3 or take a smaller portion. As a matter of fact, you don't have to take anything. I think that's what you're talking about, Ranesh. If I am mistaken, please just elaborate on what type of gratuity you are referring to. Let's see who's next. Jeannie. Jeannie says, 4 years to retirement, what do I do with an additional 15 per month? I have a tax-free and a great emergency fund. Oh, well, Jeannie, that makes things pretty easy according to me. If you are a 30% or higher, in a 30%, oh shit, what has happened here? If you are in a 30% tax rate or a higher tax rate, 30% or higher tax rate, then an endowment is ideal for you, because an endowment actually has a 5-year term. But if you're going to be investing this 15K and excuse me, and you already have a tax-free that is being maxed, if you've already got a great emergency fund, the chances are very good that you've also got a good pension fund, provident fund, or retirement annuity, and possibly other investments. Now, if you've got all of that, then you can afford to start investing 15,000 Rand into a normal endowment, whether you contribute to it for 5 years or just for the 4 years to retirement. It means that when you hit retirement in 4 years' time, you literally have to wait 1 more year with that investment before you can start withdrawing from that investment after tax money. So that to me would be the ideal type of investment. It sounds like you're going to have enough funds out of your other investments that you can go into retirement and last for the first year. So yes, I would think that the endowment would be the best option. If by any chance your tax rate is under 30%, well then the unit trust. But both of those investments, depending on tax rate, will be ideal for the time period that you've got left until retirement. My opinion, don't take it as advice, it's an opinion. At the end of the day, the only way to know if it will be workable for you and best advice for you is to do a planning session with somebody that knows investments and understands investments well. Okay. Herklaas says, I am 3 years from retirement and also had a drop of 200k. Let's see for it. Herklaas, that's now the drop in your pension fund that's gone down by 200,000 Rand. So, folks, my thing is, okay, the war that's happening at the moment, and I don't want to get into too much politics with regards to it, but I'm just going to mention the following. The war that's happening currently with Iran facing off against America and Israel and whatever the case might be. 2022, the war started between Russia and Ukraine. And for the first 3 months, the whole world was in panic about this war that started. And everybody was in panic that World War III is going to start. And it was up and down and whatever. And our stock markets also went. It was a roller coaster ride for 3 months. Then things started stabilizing, and after about 6 months, nobody said anything about it anymore. War in the Ukraine and Russia is still ongoing, but Nobody talks about it anymore. It's almost a non-issue. And since that war started until where we are now, 4 years later, our stock markets, our equity, the companies, has grown exponentially. We've had most probably 2 to 3 of the best growth years ever that I can remember since being in the industry. So that's looking back at the Russia-Ukraine war. Now, all I keep on asking myself is, with this new war happening, how long before this war and the panic that it has created is over and done with and nobody cares anymore? How long? Because, I mean, remember, before this, there was this big thing between Israel and Hamas. And that also started dwindling down. People started not caring about it anymore. Now, I'm not saying that we shouldn't care about the wars. I'm just saying that it's to me, it's like a dog that stands and barks behind the gate. And the moment you open the gate, it walks with its tail between its legs and goes lies. It's a lot of noise at the moment and not much happening. I'm not saying World War III won't start. I'm not saying other wars won't start. I'm saying I don't think that what's happening now is going to have a long and lasting effect on the stock markets. And I think it's only a matter of time before things recover and everybody smiles again and things are going well again. And like I said to somebody the other day as well, let's say that my forecast, my assumptions going forward is incorrect and World War III does start. Make peace with it. Then we all are going to suffer. Everybody's investments. It doesn't matter if you're in a bank savings account. Nothing is safe then. That is the thing. World War II wiped out 70-80% of the wealth of the world. So a third world war, and then you must make peace. Nobody will be protected. Everybody will take serious damage. So I think let's just try and stay positive, accept it for what it is, and hope and pray that we will not get there. And at this stage, I think it's a matter of time before this Iran story is something of the past as well. In any case, now I've just gotten involved in what I don't want to get involved in, and that's politics. Let me see who's next. Anybody else? Triple N, only a pleasure. Spooky. My ma sê oom moet haar unblock. Spooky, dan moet jy my kontak sodat ek weet wie jou ma is, dat as ek haar geblok het, dat ek kan sien wie sy is. Ek het geen idee wie jou ma is nie. Ek weet nie wie hy is nie, so ek kan nie sien dat ek ek het al mense geblok, trust me. Mense stuur vir my video's. Seriously? Ek's op social media. Ek plaas video's elke dag daar, so ek moet kyk na video's. Ek het nie nodig vir mense om my nog video's te stuur nie. So as jy maar een van die mense is wat my elke dag 'n video gestuur het, dan het ek al seker geblok. Maar ek dink nie so nie, Spooky of Spooky. Ek dink jy moet maar vir my kontak en vir my sê wat is mamma se naam en wat is mamma se telefoonnommer, en dan kan ons mamma unblok. Okay. As sy beloof om dit nie weer te doen wat sy gedoen het nie, wat ook al sy verkeerd gedoen het. Only RC, hello Cornelia, have you heard of a 4x4 life policy? Is it just a fancy way of sugarcoating an endowment? Excuse me. So yes, I know about the 4x4 policy, and we actually looked at it in depth at the end of last week. Years ago, when I say years ago, I'm talking when I just got into the industry, there was a policy that was called the 3-in-1. Okay, and the 3-in-1 said, I'll give you life cover, I'll give you disability cover, and you keep on paying this policy, and when you get to a certain age, normally retirement age, we will give you an amount of money. We will give you so much cash. Okay? And that was a great plan. It was a fantastic plan, or everybody thought it was a great plan. There was just two problems with it. First of all, once you lapse the policy, the whole policy has lapsed, you don't get any of the cash value back. The second thing was there was projections of 12 to 15% growth on the savings portion of it, which never realized. So people never got back what they were expecting to get. Now the 4x4 is something similar, but the only difference is that it has guarantees built in. Guarantees that says if you do A, B, and C, you will get X amount. It will start paying out at this age. It will pay out for 10 years. And that's the amount of capital we will pay out for you. So you've still got your life and disability benefits, but you've also got basically created yourself a retirement income for a 10-year period out of your life policy. Then it goes further to say, okay, well, if you've done A, B, and C, this is the amount of money we'll give you. But if you do D, E, and F, we'll give you even more. Okay, and so it goes. So all lovely, fantastic. And we've run the calculations. The amount of capital that you will get back, that you will receive in retirement for those 10 years cannot be made up through investment if we were to take that investment portion of the life policy and invest it. Cannot be made up. So it's a fantastic concept in the sense that you will get a lot of buck. What's the word? Money for your buck, or buck for your, any case. You will get a substantial amount of capital that will pay out for you. So what I'm saying is, if you do this 4x4 policy, you've got life cover, you've got disability, and you're going to get from the savings component of the investment, you're going to get substantially more than what you would get if you have a normal investment. So where is my concern with regards to this investment? My concern with this my concern with this policy is, if we have a look at statistics and what statistics says in terms of people taking out a life policy and keeping it for the rest of their lives, statistics says that people, only 3 out of 10 people keep their life policies for the rest of their lives. Okay, so you as the client needs to be 100% honest with yourself when you take this and say, can I commit and will I commit to pay this thing for the next 20 or 25 or 30 years and never stop paying it no matter what? That's the first thing. Can I commit? Number two, if there is a crisis in my life, if something happens that I did not foresee, divorce, bankruptcy, major expenses, whatever, will I then still keep on paying this thing and not make it paid up because I need the funds for something else? So can you, in good faith to yourself, ensure that you will pay this policy for the rest of your life? And if you can do it, then you can be one of those 3 out of 10 people. Fantastic plan. I can tell you now, there is nothing that can beat it. But what if you're one of the 7 out of 10 people that cannot maintain the premiums and cannot keep that policy going? Now, if you stop paying it 2 years, 3 years, 5 years, 10 years down the line, and your policy lapses, you lose your life cover, you lose your disability, and you lose all the money that you put into savings. So for me, I don't like to take that amount of risk because I cannot see what's going to happen in the future. I cannot see what's going to happen 20 years down the future, into the future. So I would rather still do the thing of saying, I'd rather separate my investments and my life policy. If I keep this life policy for the rest of my life, fantastic, absolutely brilliant. If I keep the investment, I am guaranteed that I'm going to get a return on investment. But if I had it together and I had to cancel for some other reason or lapse or whatever, I've lost. So that is the risk that you run with regards to that. Like I say, brilliant plan, brilliant maturity values, absolutely cannot argue with that. But can you do it? You know, in our industry, and over and above the fact that 3 out of 10 policies is paid for life, the average length that a life policy is held by a client, average length itself, is 7 years. And the 7 years has been proven that after 7 years, people start shopping around because there's better products in the market, more cost-effective products, whatever the case might be, and then they chop. Then they go from company A to company B. It's just the same as with driving a car. You can commit yourself to driving a car for the rest of your life. And there's some people that I know that have cars that's 20 and 25 years old. But the majority of people drive a car for 5, 7, 9, 10 years and then they change it. Because there's something better, something that's more to their liking, something that's better in terms of the product because it's more fuel efficient. Now it's the same with this life policy. So no, it's not a fancy way to sugarcoat an endowment. It is a genuine, true life policy. Whether I will sell it or recommend it to people, I'm not so sure. I think I will show it to people, but I will only let people sign on the dotted line who are 100% on board with how the product works and takes that responsibility and say, I personally take the responsibility that I will keep on paying it and I will not hold you, Mr. Advisor, responsible if one day I can't pay it or I cancel it or something like that. Okay, it was a bit of a long one. Nepleton. Tax-free savings from banks different with that of Old Mutual? Yes, it is. Like I've explained a few minutes ago, tax-free savings, you get a fixed interest rate. Tax-free investment, you get whatever the growth rate is in the portfolio, and that's where the difference is. Portfolios normally give better returns than what bank savings give, and that's the difference between them. Okay, I'm not going to go into full explanation again. Glory says, I'm 63, approved for VEP, last day is 31 March with 30 years service. Wow, fantastic. Congratulations, Glory. I hope that you will have a fantastic and wonderful retirement. I hope that the income that you are generating is going to be sufficient for you. And if you don't know what to do with your 1/3, you contact us and we'll help you with planning and investment. Okay. Please elaborate. Okay, I'm not going to go and elaborate because I spent about 5 minutes earlier explaining this difference. But the short and the sweet is a tax-free savings account is in a bank savings account where they give you a fixed interest. A tax-free investment with an insurance company is where you choose a portfolio, and depending on the risk of that portfolio and how aggressive it is, you can get, instead of a fixed growth of say 5% at the bank, you can get growth of anything from 8% to 14% if you leave it long enough and if you are willing to go that aggressive. So that's the difference. At the bank, they tell you this is how much you're going to get as an interest rate. At the investment company, they will put you into a portfolio and you get whatever growth they can get for you, which is normally substantially more than the bank. Okay, that's the difference. Leonard, as explained with regards to tax with the war just now, I spent quite a bit of time talking about my opinions. Yes, it will affect your tax-free savings. Most probably not if you're in a savings account, because in a savings account you just get interest. But tax-free investments that's invested in portfolios, yes, it will be invested because your portfolios is once again linked to equities and stuff like that. So it will also take a bit of a dip depending on how exposed you are to equities. But once again, once the market recovers in 3 or 6 months time, your tax-free investment will recover. So just don't panic about it. Don't start withdrawing funds or moving funds away. Just leave it as is and ride out the wave. Just ride it out. The problem for most people is that people want wealth to build over 20 years, okay, or 30 years. They want wealth, big wealth, over a long period of time. But then they worry what happens between today and next week Monday. Don't worry about what happens between today and next week Monday. If you've got 30 years or 20 years left on your investment, don't worry about it until 2 years before retirement. That's when you worry about it. I don't say don't look at it. Review it yearly with your financial advisor so that if you decide you don't want to be in a local equity fund, but you want to have more in a global equity fund, so that you can do changes like that. But just don't fret about it on a daily basis. Just not worth it, because investment wealth is built over time. And jumping from one thing to another thing does not help. You have to stay invested. Is it true that tax-free savings account of Sanlam is not taxed if it exceeds 46,000 a year compared to tax-free? No. A tax-free savings account of Sanlam is not taxed if it exceeds 46,000. Tax-free is tax-free. Okay? Tax-free is never taxed. Never, never, never. As long as you don't put in more than 46,000 Rand per year into your tax-free investment, then nothing is taxed. It doesn't matter if you put in 46,000 Rand, you get 46,000 Rand growth. It's tax-free. That is why it's called tax-free. So it is true that Sanlam and all other companies' tax-free investments are not taxed, even if it exceeds 46,000 Rand per year. The only time you taxed is if you put in more than 46,000 Rand. Then every Rand that you put in extra, you taxed on 40%. That's why you should not put in more than what the law allows. Okay, let's see where we're going. JJ. Well, folks, I think I'm going to run out of time tonight, but so be it. Hi, ek is 57, tree af op 63, pensioen so 5.5, hulle sê dit sal verdubbel laaste 5 jaar, is die waarheid? JJ, dit behoort, ek sal reken dat dit behoort dit te doen, as jy in nommer 1 goeie fondse belê is, en die fondse het baie goed gedoen die afgelope 3 jaar, dan behoort dit te gebeur, want onthou, in hierdie 5 jaar gaan jy nou goeie groei kry, kom ons sê nou maar 9 of 10% groei, en jy dra nog steeds by tot daai pensioenfonds. So, jy behoort te sê dat jy jou fondse om en by te verdubbel in die laaste 5 jaar. Jy kan altyd vir jou sommetjie doen, jy kan altyd vir my laat weet waar jy belê in terme van jou pensioenfonds, by wat 'n maatskappy of wat 'n portefeulje is en wat jou bydraes is, en dan kan ek vir jou vinnig 'n sommetjie gaan doen en ek sal vir jou sê wat die kanse is dat jy dit gaan verdubbel, maar ek dink die kanse is relatief goed, definitief. Tic-tac-toe, only government gave this type of salaries. Let's not go there, let's not go there, let's not go there. Thank you, Tic-tac-toe, it's indeed so. Also investments, so all investments will be affected, indeed. Oh man, folks, seriously. Ayo, do banks have better interest on tax-free savings accounts than other financial institutions like Sanlam? Ayo, my China, this is the 4th time tonight that I'm saying this. No. Tax-free savings accounts at banks do not have the same growth as tax-free investments with institutions like Sanlam. As long as you pick a portfolio that's medium to high risk or high risk in a tax-free investment, the chances that you're going to do better in the bank always is like 99.9%. So I'm not going to go into the detail again because my throat is dry from explaining this tax-free exercise. But yes, tax-free investment with Sanlam going to give you better growth than tax-free savings account in the bank, especially if you leave it over the long time, okay? Might not be over a short term, but in the long run, it will be. Okay. Yo, I'm leaving it there. Let's see. Okay. Only RC. No, this is not true. 40% on every Rand over. Yes, that's correct. Only RC. Tax-free investments, the law says, and it's been from the 1st of March, you can invest 46,000 Rand per year into your tax-free investment, 500,000 Rand over your lifetime, so 46,000 Rand for basically 11 years that you can put it in, then you filled up your 500,000, but if in a specific year, you put in more than 46,000 Rand, let's say you put 50,000 Rand in here this year, that extra 4,000 Rand, you get taxed on 40%. Klar, finish. Because the rule says, you can only put in 46,000. And SARS says, if you're going to break the rule that I've put there for the help I'm trying to give you, I'm going to tax you, and I'm going to tax you hard. So yes, it is true. If you put in more than 46,000, you get taxed at 40%. Just accept it, brother, sister. Don't know, only RC. Where does one save for emergencies? MSLA. I'll repeat this one more time. I believe the bank is still the best place for emergency funds. Mo Pele says, which one is best, buying property or investment? My personal opinion, I do not like property. I've seen too many people that have gone bust because of property. I've seen too many people literally going bankrupt because of property, losing on property deals. So if you want to invest, my opinion is then you must take up an investment, okay? If you want to buy property and you want to rent property out, then you're not investing according to me. What you are then doing is you're starting a property company, because you have to manage that property. You have to manage the people renting from you. You're running a small business in the sense that you've got one property that you run like a business because you get a rental income. So it's a property business, it's not an investment. The only time when property is an investment, according to me, is when you've got at least 5 properties. They paid off, they bought cash, okay? And you're renting them out. And then it's still actually a business, because you are the person that have to look after the people renting, you have to address all their problems, etc., etc., etc. It is only a true property investment if you just stand to the side and receive the rental income, and you've got somebody managing it for you, and you can choose to sell it and rent it as you please. But no, I will never advise somebody to buy a property instead of investing. Rather invest, headaches is a lot less, return on investment is very good, most circumstances, according to me, better than what you would get in property. So that's where I go. Okay, tic-tac-toe is on everybody's case here tonight, so let's move away. I'm allowed to exceed 46,000 1 year period in insurance company and not taxed. No, Nepleton, I've just told you. 46,000 Rand is the maximum. Put in more than that, you pay 40%. If you don't want to believe me, you don't have to, eh? I'm telling you the way it is. But you don't have to believe me. You are welcome to go and Google it, ChatGPT it, go and phone 3 other financial advisors. I'm telling you as it is. And if you don't believe me, go and speak to SARS as well. Bason Ella Jackson K. Chew. I'm 26 and I have 500k. Which investment option that can pay me on a monthly basis? If you're 26 and you've got 500,000, okay, there's a number of investments that you can use to make use of something like that. You can have a bank savings account, you can draw the interest. You can take up a unit trust and you can draw a small percentage from it. You can take up a guaranteed income plan that pays you for the rest of your life. So there's a number of options that you can exercise. It's all going to depend on what you want, how much you want, how long you want it for. So the only way to basically advise somebody like yourself is, once again, to have a consultation, look at what your needs are, and then give you a plan in line with your needs. If you had, hold on a second, I have to do this funny thing that I have to do every time. Wow, okay. Folks, I hope okay, there, we've been through that one. If you had to ignore all subjective opinions, what is the best foreign versus local exposure? I'm comfortable with 70-30. Easy as that. I'm comfortable with 70-30. I'll even go as much as 80-20, depending on the type of client I'm speaking to. Stan says, Konay, how much money can you withdraw from your RA at age 55? Stan, 1/3. That's the short answer. You can withdraw 1/3 of your RA, and it all is dependent on taxes and so on. Where does one invest for tax-free besides the bank? Old Mutual, Sanlam, Coronation, Allan Gray, Investec, 10X. The list goes on and on and on and on and on. There's many. Which one is best? Buying property? Okay, I've been through that one. I'm not going to say that one again. What do you think of a Provident Fund? Provident Funds is outdated. It was a wonderful investment in years gone by, but people abused the money in their provident funds because they could withdraw everything, and they did so, and then they wasted it, and then they were poor and they didn't have money. And so what happened is that provident funds, although they still exist, and you can't take up provident funds anymore, and the rules of provident funds was changed so that it now works like pension funds. So provident funds were good, but they are basically exactly the same as pension funds these days. And the preservation fund you're referring to is if you belong to a pension or a provident fund with a company and you resign from the company before the age of 55 and you want to preserve that money, then you transfer to a preservation provident fund or preservation pension fund, and that is one of the best things that you can do to make sure that you don't go and use the money that you're going to need in retirement. So I like provident funds if people use it correctly. Please don't do that ever. Approach Kuraya as for the best. Okay, thank you very much, Tic Tac Toe, mate. Your check is in the post, okay? Shoma says, hello, what is your consultation fees? Okay, Shoma, I charge a consultation fee of 1,950 Rand for the first consultation, which is a information session, a planning session, and feedback session. And if I need to see you 2 or 3 times, it's all incorporated in that fee. After that, all further fees are discussed between me and you, depending on circumstances. Where was I? I think I lost now. Okay, that was Pete in the Provident Fund. Okay, just finding the next one. Is it advisable to invest 10 Rand in a bank? Sky? I don't even know if it's advisable to invest 10 Rand in a piggy bank. Oh, 10 million. Oh. Okay, Sky. No. My opinion is no. It's not advisable to invest 10 million in a bank. So I would say no. Oh, sorry, I missed that one. 70, 40, 30 local, correct, G. That is the way that I feel about it. 100%, 70%. Shoma, what is your... Oh, the consultation fee, 1,950, like I say. And then after the first consultation, we discuss further. Sorry, Tic Tac Toe, I've upped my fee. And that's why it's not 1.5 anymore. Yes, I did go to 195. Ladies and gentlemen, Pete says, do you know Mark Hoffman? Yes, Pete, I do know Mark Hoffman. Young man that I believe is going to make it great in the financial industry. He speaks to me on a pretty regular basis. And yeah, I'm giving him a bit of guidance in life because he's a young up-and-coming financial advisor and I'm trying to help him with some guidance. So yes, I do know him. Ladies and gentlemen, it is 7:02. My throat is hoarse. I forgot to grab myself a bottle of water tonight. So I'm going to say thank you very much again for attending. Hope you learned something tonight. If I can be of more, more with you guys, please do not hesitate to reach out to me. I try and answer everybody. You have a good and wonderful week. I'll speak to you again next week, Thursday. We do the same thing, same time, next week, Thursday. Okay, folks, all the best. Keep well. Bye-bye.